Okay, so Element Fleet Management. As Ryan said, they are the largest automotive fleet manager in the world. They offer management services, including vehicle acquisition, maintenance, accident handling, remarketing, and also electric vehicle integration. So, customers that are starting to use EVs in their fleet, obviously, they need management in terms of being able to charge them, maintain them. Element services corporations, governments, and not for profits across North America, Australia, and New Zealand. The company symbol is EFN on the TSX. It's trading right now at about $22. It's a almost $9 billion market cap company, and it has a yield right now of 2.2%. Looking at the company's share price appreciation over the past 12 months, pretty reasonable growth, starting the 12-month period at about $19. Right now up about, as I said, just over 22, but a lot of volatility along the way. So let's take a look at this business, starting with the recent financial results. Q3 revenue increased 3.3%, so a little better than flat to 333 million. Adjusting operating income up just under 4% to 185 million. And adjusted operating margin improved by 30 basis points to 55.4%. So nice, healthy operating margins for this business. Adjusted EPS of 35 cents, up 6.1% compared to the third quarter of last year. Somewhat better growth in the year-to-date period. So for the first 9 months of 2023, revenue growth of 14% to 960 million. Adjusted operating income up just under 12% to 528 million. Adjusted operating margins were actually down 140 basis points to 55%. Still very strong operating margins. And then adjusted EPS up 18% to 98 cents. So one of the things that I've really wondered about Element Fleet Management is just really what they do. They really market themselves as a fleet management company, which to me, it implies a service business. You're providing you're getting a fee for a service, which is managing a fleet of vehicles. But I also noticed that there's a lot of financing in their business as well. So let's break apart the year-to-date revenues and see what comes from financing, what comes from service. So service income was 502 million in the year-to-date period, whereas financing income was 415 million, and then syndication revenue 43 million. I'm not sure what syndication revenue is, but it's the service revenue, the financing revenue that really dominate the company. And we can see here that yes, it is a fee-for-service business, but that's only a little more than half of the company's revenues, and in fact, close to half comes from financing. So essentially making loans, receiving interest payments in return for those loans. So this is something that I'll touch on in a couple more slides because it's really important in terms of analyzing the business. Now, the company has put out guidance for 2023 and 2024. For the current year, we only have one quarter left. They're looking at about 7.5% at the midpoint of their guidance, 7.5% growth in net revenue, 8.5% growth in adjusted operating income, adjusted EPS in the range of 126 to 131, which would be 14% growth year over year, and then free cash flow per share of 158 to 163, which would be up 15% from 2022. And then looking at the 2024 guidance compared to the midpoint of the 2023 guidance, revenue is expected to be up 10%. They're expecting about 100 basis points improvement in operating margin. Operating income expected to be up 11%, adjusted EPS 12% to 141 to 146, and then free cash flow per share, they're expecting to be up 11% to 175 to 180. The company did discuss some strategic initiatives which it is focused on in order to drive growth going into the future. One of these is centralizing the US and Canadian leasing operations, so a consolidation of management for the leasing operations in North America. Another is establishing a strategic sourcing presence in Asia. So this is opening a new office in Singapore, which strengthens the global procurement capabilities of the company. They're advancing their digitization and automation focus in order to drive future growth and as well as improve operating efficiencies. They want to focus on a capital light business model. So, shifting towards a business model that relies less on capital intensity. I would imagine this is stepping away from their financing business more. So, this includes growing their services revenue, syndicating assets, and also providing access to cost effective funding. And then also optimizing their capital structure. So, they have plans to redeem high cost legacy preferred shares. As well as streamlining their capital structure. Now, when I look at the company's historic performance, I see good growth in 2022, good growth also expected in 2023 and 2024 for the full years. But really, previous to 2022, and I only go back 5 years, the company has a longer history than that. Not really a lot of growth and really some fluctuation in financial performance. So it seems like the consistency of growth hasn't really been there. We're starting to see growth ramp up now. Certainly, if the company is able to hit their targets going forward. Looking at the balance sheet, and this is a concern for me, $10.2 billion in debt, only about 75 million in cash, 3.9 billion in equity. So that's a debt to equity of 2.6. I'm not as concerned about that as I am about the debt to EBITDA. I have it at almost 14 times. So that's a high multiple. Now, I think that this has a lot to do with their focus on financing. Analyzing the balance sheet of a financing company is different than analyzing the balance sheet of a conventional operating business. But they do market themselves as a fleet management company, which I understand to be a service business. So looking at that, debt to EBITDA multiple of nearly 14 times is well outside of our comfort range. We're generally, for a cyclical business, less than half times EBITDA or less than 1 times. For a company that has like moderate cyclicality, maybe from 1 to 2.5 times. Some businesses can get away with higher debt to EBITDA multiples, like utilities or companies that are defensive. But even then, you're usually talking 5, 6, maybe 7 times. So this looks to me like a high debt to EBITDA multiple. And then looking at valuation, so based on their 2023 guidance, trading at about 17 times price to earnings, trading at about 15 times their next year's adjusted EBITDA guidance. So what do we think of the company? Well, positive financial performance in 2022 for the first three quarters of 2023 as well. They also have a positive outlook for growth going into 2024. They do have a growing dividend, and they have potential to drive efficiencies through data analytics, which is interesting. The valuation is okay, but I'm going to touch back on that in a second. Few of the things I don't like about the companies. One, it's a very complex business. I don't know how to value it. Do I value it as a financing company? Do I value it as a service business? Nearly half of the revenue comes from financing activities. They also have high debt leverage, not really a great history of consistent growth in revenue and earnings per share pre-2022. So our take here, the debt is a concern. And when I look at valuation, if this were 100% or even an 80% service business and it was just fleet management, then I would say that the valuation starts to look pretty good. But as a financing business, I would expect the valuation to be lower. So just for example, the banks, they're all trading for less than 10 times earnings, right? So 15 to 17 times for a company that is largely or almost half financing, that's starting to look like maybe the valuation isn't that attractive. So this is a company, we'll continue to monitor it. It's interesting. They seem to have good potential or momentum in their financial performance. But debt certainly is something we would need to dig deeper into. And also just how to value it. Are they going to maintain that big focus on financing, or do they want to shift more to the service side? And I'll open it to you for comments.
Okay. Well, I mean, I think you did a good summary on the business. I think that in terms of There has been good results over the past couple of years, but if you go back to 3-4 years prior to that, they're kind of just equaling the revenue level they did at that point. And I think the growth multiple that you're asked to pay for the stock right now, in my opinion, doesn't equate to the growth that you're going to see in the business. So I think it's fair. It would be fair value, in my opinion. I don't think you're getting much. You're not getting. There's not a ton of growth if you look back 3-4 years, and the multiple that you're being asked to pay is more of a growth year oriented multiple for a finance related company.
Yeah, I was a little surprised too when you did get to the balance sheet because I was reading their conference call as you were doing your section, and they're talking about they've just recently increased their annual common dividend by 20%. They're also talking about redeeming their remaining outstanding preferred shares. So I don't know how much that'll be. They're continuing to buy back shares. So I mean, they do have, what was it, under 100 million in cash, but this might eat into that. It's going to be. I was a little surprised. Anyways.
And I will say as well, the syndications is them creating asset-backed securities, so that can just be seen as financing revenue, really.
So it really is about 50% of the business.
Yeah.
In financing.